Hey guys, compliments of the season. It's the disclaimer here again, and I would just like to say a few words before um, I begin the presentation. Of course, um, where whatever I'm here to share this very moment, for me, it's very very important because it is one of those things that was missing in my trading. Okay, in my technical analysis and how I view price from the perspective of liquidity because um, this discussion will be based on liquidity, and I have never, absolutely never talked about liquidity like this before. And one of the major, reasons why I did this video was because I had lots of questions the previous trading year. I don't know if you are this person or you've ever been in a position where you see liquidity pools, for example, say relative equal highs or how we call it, and you leave them on for targets. I mean, you say wherever you're trading from, whether you're trading from external or internal range, say, and you're targeting, certain levels of liquidity, and price didn't actually trade through those levels. But they actually did drop price close to them, but they didn't trade through those levels, and it has happened consistently. And you still do not have answers to those questions, and then you wonder, you ask yourself, these things that happen, are they really really random? Do you really know what you're doing, or is there a fault in your analysis? Well, I'm here to bring to light about those problems, and if you think you have this problem too, as well as the others I will be addressing, well, this video is for you. So keep watching. Yeah, this is January 2022 TWA mentorship, and today I'll be discussing qualitative analysis. And under this module, because this is one of two installments, and because I'll be producing yet another video subsequently after this one, and yeah, I'll be discussing about liquidity runs. And I know in the month of May or something, I said I was going to produce a video on liquidity runs, and I wanted to, but I told myself that instead of rushing to produce the video, why not gain as much experience as possible with your idea and theory of liquidity runs? Although the idea of liquidity runs is not mine, courtesy of ICT being a circuit trader, and I've kind of like heard one or two things about liquidity runs from him, but there's not much materials that really discuss about liquidity runs of his online, and so it kind of like took me a long ass time period to really figure out what it really meant about liquidity runs. Now, before we get into the nitty gritty discussion about liquidity runs, I would really, really love to at least brush up the basics because I really do not know who is, seeing this video. I don't know what stage you are in your development, and I really want to just, do what everyone always does when you're introducing something, and just go through the basics. Now, if I ask you, listening, what's liquidity? How would you define it? Now, you could take some time off, maybe 3 seconds, or pause the video and ask yourself, what is liquidity and how do you define it? Okay, and now, mind you, this video we're talking about qualitative analysis. That's basically, the whole thing we see on the price chart, not quantitative analysis, qualitative analysis. Okay, quantitative will have to do with numbers, but qualitative has to do with things that are not fixed. Okay, they are not metrics based. Okay, it's not based on numbers. All right. So yeah. So In my opinion, I'd say liquidity is just a term used to understand orders actually. Okay, and if we are speaking about orders, what do we mean? They are essentially buy and sell orders that are in the marketplace. Now, this is forex, this is foreign exchange, and we know everything we do is buying and selling. So, liquidity is just a term used to understand these orders that are in the marketplace, and essentially they are waiting to be paired up by a counterparty. Now, we define liquidity in two ways. Okay, here I just showed you the first one as external range liquidity. Okay, and the other would be internal range and liquidity. And in both um, in both ways, we used to address the concept of liquidity. If we pick the external range, I think everyone is quite familiar with um, areas in price we used to evaluate external range liquidity, and one of which is the classic old highs and lows. Okay, because anything outside a dealing range is what we term external range liquidity, and basically it's the old highs and it's the old lows. They are the only PDRAs outside an external range, or sorry, outside a dealing range. Okay, and if we should talk a little bit about internal range liquidity, that has to do with majorly the P areas in a dealing range, and it's simply the order blocks, imbalances, and the rejection block. Now, if you look closely at this chart, sorry, I mean this presentation, of course, I actually made a few words. I made them bold. That the old highs and lows and the rejection block, and it's absolutely for a reason. Okay, it's not coincidence, because um, they are the major thing we'll be talking about today. I mean, the old highs, lows, and the rejection block. Now, whenever Michael discusses about liquidity, okay, most of us, we are accustomed to the fact that we know there are pools of orders resting above an old high or below an old low in form of buy stops or buy side liquidity, and below an old low in form of sell stops, sell side liquidity. And also, we also know about the concept of liquidity in on the rejection block. That's on the bodies of the candles in a swing point, or below the bodies of candles in a swing point. But what we really do not integrate in our analysis, in my opinion, I would say in my analysis, in my opinion, is the same way I view the ideas surrounding, liquidity using old highs and lows. I could actually replicate it using the same concept or the idea when I'm talking about the rejection block. Well, now this picture actually would all I did here was to just highlight lows in the marketplace, and each one of these lows, each one of all of these lows, okay, we believe there are self stops resting below this low, because it's of the general idea that anyone who goes long, or anybody who goes long here, will ideally put their stop below this low. Okay, and if you are buying here and you put a stop loss below this low, because with the idea that okay, it should protect you for whatever unprecedented movement. Okay, and say probably there were some large funds. If we assume that some entity went long here and definitely and placed stops below this low, once the market trades below this low, okay, and neutralizes the stop below this low, the market will actually trigger that order for sell. Okay, it means you have to forcefully or unwillingly sell all the positions you bought, maybe above here, somewhere here, around here. I really do not know. Now, conversely, for traders who think of market in form of breakout system and say if prices trade below this low, okay, they would want to sell short here. So they are willing participants and unwilling participants of sell orders below this low. That's why we tag that sell side liquidity. I think if you see the ICT market maker series, I think volume 2, he just did a similar explanation of sell side liquidity. So I'll not spend much time here. And the same thing is above old highs, there are pool of buy stops resting above old highs. Okay, even discussing the same narrative I used to, discuss the idea of sell stops. Okay, it's the same logic behind. So anyone who is going short below this swing point will ideally place their stop loss above this high, and that stop loss would be seen in form of buy stops in the market. Okay. Yeah. Earlier on in the earlier in the beginning of the presentation, I was talking about liquidity resting above and below the marketplace, and the one which we do not always talk about is liquidity resting at the rejection block. I think everyone is quite familiar about this PD array, but it's not really invoked in our qualitative analysis, and it's something I actually have noticed over time. It's something that has it's something that's even plagued me personally, and I I've now found reasons why I should, and all of the other components that support the narrative when I'm trying to look at the rejection block. Okay, so just like below the old low, okay, at the bodies of the candles, okay, there are pools of stops resting at the bodies, that's sell stops. And for the rejection block, we should know that the dealing range for the rejection block is from the body, that's the opening here, to 50% of the rejection block, and 50% of the rejection block is consequent encroachment. So once you use your Fibonacci tool to measure 50%, okay, you split it in half, that's your daily range. Okay, it's sensitive at the body like you see here, and also sensitive at the consequent encroachment of this rejection block. Okay, Michael will call this a gap, okay, because we refer to the midpoint of the gap as consequent encroachment, and the midpoint of an order block as the mean threshold. Okay, so this is a gap, so 50% of it is consequent encroachment. So it's sensitive at the bodies and also sensitive at the what, the mean consequent encroachment, sorry. Also, the same applies for the rejection block, and that will be the bearish rejection block. So we're talking about buy stops resting above the bodies of this candle. Okay, so you can see the sensitivity at the midpoint of the rejection block, also the sensitivity at the midpoint of the rejection block. Now down to the major topic of today, that's liquidity runs. And this is the reason actually why I started this video, liquidity runs. And liquidity runs is very, very important. But before we discuss why liquidity runs are important, what are liquidity runs? Now, my definition of liquidity runs, I say is the pairing of orders, of new orders, okay, and that's keyword, okay. It's pairing of what? New orders that are counterparty to existing orders, okay. That's liquidity runs. And there are numerous ways, actually there are about two variants through which we can use to classify liquidity runs. But the way we visually represent or we see liquidity runs on the chart is via turtle soup, okay? And everyone is conversant with turtle soup, okay? Then I used to define turtle soup as the first break above an old high or low, okay? But having brought to light the idea of the rejection block, talking about um, the um, the concept of liquidity above or below the rejection block, we can also further redefine turtle soup as, the run above or below liquidity pool. So what am I trying to say? Um, what I'm trying to say in essence is that once price runs to a rejection block, we could actually classify it as a turtle soup. Okay, I would have to just fall back a bit now. Price trading into the bodies of this candle, okay, sweeping, okay, sweeping, not purging, sweeping the buy stops. There's a difference between when you sweep a liquidity pool is being swept and when it's being purged. Okay, a liquidity pool that has been swept, price could always still come back to trade through at a later time, but something that's been purged is has to do with liquidity that's actually been neutralized in that area. Okay, and so we could call this a turtle soup. Okay, price trading into the rejection block, sweeping the buy stops resting above the bodies of this candle and ultimately reversing. Okay, so this is another form of what turtle soup. This is what turtle soup. Okay, because we are what we are sweeping the buy stops resting above these highs. Okay. Now, it's also is imperative to know that the markets move to go to an area of liquidity or liquidity pools. Okay, and not only does that, there are other reasons why the market moves. Okay, like market goes to an area to rebalance, or the third and the final is central bank repricing. Okay, these are the three basic, not basic, these are the three ways through which the market book or deliver. Okay, the first is they move to go to an area of liquidity, the second is an area to rebalance, and the third is central bank repricing. Okay, and okay, after talking about liquidity runs, which is pairing of new orders that are counterparty to existing orders, it's now still very important to now say what's important about liquidity runs. Now, we as informed money traders or smart money traders, what really distinct us from the retail crowd is the idea and the concept of liquidity we are using to trade, and and this in itself it's very important, okay, for us, even for the intraday and for various market profiles, because there will always be runs on liquidity, either in a consolidating market profile or in a trending market profile. And a very good understanding of liquidity runs would really help navigate through price actions, especially for times when we say price consolidates and we really do not know what's really going on, okay, in the price chart. Okay, liquidity run is one of the most effective ways to actually trade and navigate through price action, because basically it's pairing of new orders that are counterparty to existing orders, and there's a vast array of application of liquidity runs. Okay, so and besides that, we know that when price trades through a liquidity pool, for example, okay, and there's this general not there's this idea that we always say that smart money sells to buy stops and buys to sell stops. Okay, this idea in itself has framed the basis for how we take a trade and exit a trade. But now, there's a hidden truth in all of this, okay? Not all liquidity pools will be run, okay? Some will be maintained, some will be taken out at a later time, and we need to know exactly what liquidity pool we need to use for targets and what pools we need to even use for entries, okay? So it's still the same thing I said. I said not every liquidity pool is available for willing or unwilling liquidity runs. Now, how do we now see liquidity runs in charts, okay? And how do we classify these liquidity runs? Now, for us to understand the idea of liquidity runs, there are certain things in price. What we are talking about here is simply qualitative analysis. There are things we need to see on the price chart, okay? And the first, we introduced the idea of liquidity and talked about, the rejection block in itself and the classic old highs and lows where everyone, look for a run on liquidity. Now, we need to understand something. What happens after a liquidity pool has been neutralized? Okay. How do we qualify that a liquidity pool is available for transaction? Because the truth is, everything that occurs in the market is just business. Okay, is business. Maybe you should think about that. Okay. Now, the answer to these questions will give us a crude depiction of what we look out for a liquidity run signature. Okay, what happens when price runs through a liquidity pool? How do we qualify that a liquidity pool is available for transaction? Okay, and that brings us to high resistance liquidity run and low resistance liquidity run. Now, from the idea of high resistance liquidity run, it means there are some liquidity pools that are going to offer high resistance. That means it's going to be difficult for price to trade through them. Okay, even regardless institutional order flow, because certain conditions will have to be met before these liquidity pools will be available for transaction. Okay, that means the certain conditions will be met before price can actually trade through them. Okay, and also low resistance liquidity runs, if it's literally the opposite of high resistance liquidity run, so that when we are looking at certain liquidity pool that will offer resistance to price, there are actually some liquidity pools that will offer little or no resistance to price. And in my opinion, if we can visually see these things in price, I think it's 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 a beautiful thing actually. And imagine if you could transpose it on the higher time frame. You know what that means, okay? So my point is, even the idea of liquidity run signature, okay, we could use them for day trading, we could use them for short-term trading, we could use them for long-term trading. And usually we look at the price chart and we say, oh, this is the draw on liquidity. How do you know this particular swing point is actually a draw on liquidity? Is it a low resistance liquidity run? Is it a high resistance liquidity run? What are those things you see in price that will make you think that price will trade through? Although basically, Michael said something. He said, whenever he says draw on liquidity, all he's saying is that he just wants price to trade, drop price to itself, that it doesn't need to trade through. That's very smart, or that's being very diplomatic, in my opinion, because being diplomatic in the sense that even if a liquidity pool doesn't get run, okay, we already established fact that price might probably trade very close to them and maybe reverse. So he answered the question in a way that it it suits both conditions when it's probably high resistance or low resistance in itself. Maybe because he doesn't want to share this his mentorship content, because this one is actually mentorship content. Okay. Now, earlier on, I I gave us two examples of a liquidity run signature. I said we were talking about high resistance liquidity run and low resistance liquidity run. Okay. Now, how do we visualize high resistance liquidity run and low resistance liquidity run? Now, looking at the chart now, if we should envisage this as a price chart, obviously bearish, and price, just drops like this. I think if you've seen ICT 2016 mentorship series, I think this was the third one he was talking about then. He said, whenever price trades aggressively through levels, this obviously creates a liquidity void, all right? And, it creates a short-term high and breaks above this short-term high, okay? This looks like we're in a bearish environment, right? And price has traded aggressively through. And price has traded aggressively through. It created a short-term high, broke above the short-term high. What he said was that this already shows you willingness that price is going to rebalance. Okay, mind you, I said about 3 ways through which price move. First one is markets will move to an area of liquidity. The second one is prices will move to rebalance, and the third one is central bank repricing. Okay, so as soon as market breaks above this short-term high, okay, every subsequent high created until price trades up to this level, okay, this swing point will be termed low resistance liquidity run, meaning prices will find it easy to trade above every high that is being created subsequently until we get to this very point. Now, this is what I mean. Definitely, once we break above a short-term high, it's only very normal to anticipate a retracement in price, right? Very, very normal to anticipate a retracement in price, and and we already said once price run above a short-term high, okay, every high created subsequently will be what termed low resistance, meaning price will find it easy to trade above what these highs. So it's okay to anticipate price running above this high, and we could still see a sort of retracement, and eventually till we deliver price to this swing point. Now, sometime last year, I made a video on efficient price delivery, and things we need to see, especially when we see ranges such as this, and we can confirm that prices has been delivered efficiently. Okay, and one of the bases behind the premise of efficient price delivery was me using the idea of liquidity runs. Okay, because I know for sure that once price trades up to this level becomes what? High resistance. Okay, so it means once we've fulfilled our objective to this very swing point, okay, prices will find it difficult to trade above this level at first. Now, if you look at the price charts, obviously we look like we're in a trend, and this is only applicable for scenarios especially in trending market conditions. Okay, I'm not talking about consolidation. This is liquidity runs in trending markets. All right. So it means in a trending condition, once price trades up to this swing point, this high will be tagged as what? High resistance. So it means once price leaves this level, any further bid for price to retrace up to this dealing range, price would not be able to trade above this high. Okay, and price subsequently will trade to the high, and eventually can trade lower. Okay, so if we were in a bearish environment, this would be like, I think this can be somebody's template for short. So when price creates a void and creates a short-term high, once it breaks through the short-term high, every subsequent high will be low resistance. That means it will offer little or no resistance. Price will easily trade through these levels until when it gets to this swing point. When it gets to this swing point, this high becomes what? High resistance. Okay? Considering the idea that we're in a trending environment. We're in a trending environment. That's the key note. Okay? The key takeaway from this is that this will happen in a trending environment. And when price subsequently trades through this level, okay, if we measure this dealing range, when price trades to any premium array in this dealing range, prices will offer very strong resistance. So the inefficiencies you may see here would, will be left open. Now, one of the side notes is that once prices trade up to this level, okay, and begins to break down, this level, it's no more what? It's no more high resistance, okay? It becomes low resistance, and I'm going to show you why. Now, I pulled up a chart on the euro dollar on a monthly time frame, and kind of like still on the premise of liquidity runs, and this is a break, okay? There's lots of voids, and soon as prices traded above the short-term high, okay, the market still, this high would be what considered what low resistance. And I don't want to talk about whatever happened here. If you look through here, I think you can really get what happened here. And prices trade high to what the body of this mitigation block, and to rebalance this what sell side imbalance. Okay, so price trading up to this specific level makes this level what high resistance what liquidity run. So when next prices is trading back, not retesting this level, once price starts to trade back, it will find it very difficult to trade above this intermediate swing point. Okay, because this is what a high resistance liquidity run. The market will offer stiff resistance for price to trade above. And in fact, we even saw it clearly here as we consolidated in this area for quite an amount of time. Now, down to the major lesson, because this concept I'm about to show you is one of the reasons why I even started the video, okay? And it's looking at liquidity runs based on, the classic idea of market structure. Now, whenever we see prices trade above a short-term high, invariably what happens is that a high resistance liquidity run has been enacted. Although there are other conditions to make a swing point high resistance, which I'm going to share after this slide. But I just want you to see it in a naked format, okay? When price trades above a short-term high, okay, makes it high resistance. And high resistance liquidity run is just denoted by, the higher highs, okay? Once you see higher highs in price, chances could mean that it's a high resistance liquidity run. Now, once you see lower highs in price, okay, chances are it's a low resistance liquidity run. Now, these were ideas for bearish scenarios, okay? For bullish scenario, this is a high resistance liquidity run, okay? A lower low, okay? Just basic market structure. So when you see higher highs, high resistance liquidity run, lower highs, low resistance liquidity run, and lower lows, high resistance liquidity run, and just about the same. So this in a naked format is how we can identify high resistance liquidity run and low resistance liquidity run in the markets. Okay, I'm still going to talk a bit more about it. Okay, and I'm going to tell us reasons why we see certain things, or we see signatures such as a high high as a high resistance liquidity run, and signatures such as a lower high as a low resistance liquidity run. Now, what makes a swing point high resistance or what, or low resistance? And the first point to consider, a swing point is considered high probability, or high resistance when transactions occur at two opposing liquidity pools, essentially in its dealing range. Please don't mind the sentence construction. I'm sorry. But what I was trying to say in essence is that this swing point in question must purge a liquidity pool. Could be an old high or low, or even a rejection block, and offset orders at a liquidity pool. That's what makes a swing point high resistance. Now, this swing point was what first purge a liquidity pool, okay? And after purges a liquidity pool, it will now offset orders at an opposing liquidity pool. Now, purging liquidity pool would mean a raid or thorough soup above an old high, below an old low, or even thorough soup in a rejection block. In fact, the one I'm going to even stress amongst these ones is this swing point must purge a liquidity pool at a rejection block and offset orders at an opposing liquidity pool. Now, prices could purge, I didn't say sweep, I said purge. Now, prices could purge a liquidity pool in the sense of rejection block, and also offset orders by even trading into an opposing liquidity pool that is also a rejection block. If that was too much, I think you should just take a pause on the video and re-listen. Okay, meaning a swing point maybe purge a liquidity pool at a rejection block. Okay, maybe raided sell stops at a rejection block and traded into an opposing liquidity pool of buy stops, but didn't trade an old high or trade above an old high, but only traded into the bodies of that swing point, also a rejection block. And the idea of smart money buys to sell stop and sells to buy stop. So if they bought at the sell stop resting at the rejection block, and prices trades into the bodies of an opposing liquidity pool of buy stops, even still at the rejection block, and where else do you think they'll be profiting or taking profit from the earlier profitable position, which was at a previous liquidity pool? It's still at the opposing liquidity pool of buy stops. Smart money buys to sell stops and sells to buy stops. So it could also mean the idea of the classic old highs or lows, or it could mean in the idea of what? Rejection blocks. So what will qualify this skeletal depiction of a high resistance liquidity run means price trade above an old high here, for example, and probably trade below to run an old low. Okay, this high then I can target as what? A high resistance liquidity run, because there was a transaction above this old high and also a transaction below this old low. So this will be what? High resistance. This will also mean a high resistance liquidity run if we traded below an old high. Okay, sorry, we traded below an old low and price traded above an old high to offset positions that were previously accumulated below this old low. I don't know if that makes sense. So if that makes sense to you, it means this swing point would be what? High resistance. There was transaction of buying to what? To selling. Okay, like I said, everything in foreign exchange is just business. Okay, buying and selling, and we must understand these large flows to be able to understand institutional order flow. Anyways, I'll be discussing about that in the next installment. So Already, I think looking at from the previous slide, I think this makes sense now for us to say this swing point was what? Purge a liquidity pool, an old high low or rejection block, and offset orders at what? An opposing liquidity pool. Now, when a swing point, that means when the swing point in discussion, that's the high resistance liquidity run, gets traded into, when price trades back into a pool of liquidity we considered high resistance. Now, I'm not talking about retest. I'm talking about price trading into. That means price traded maybe higher, then retraced. Okay, there was a series of down close candle retracing back into that swing point. Now, this occurrence in price action mitigates the swing point. Okay, and thus reducing its probability. Okay, when a swing point that was initially regarded as high resistance, I mean something that's transacted between two opposing liquidity pools already, once prices trades back into that swing point, it mitigates the swing point, reducing its probability as high resistance. Thus, it becomes low resistance. Okay. Now, mind you, if we look just above here, I was trying to make a discussion about what makes a swing point high or low resistance. I said, first one I said was a swing point. Once I said a swing point is considered high probability when transaction occurs at two opposing liquidity pools, okay, in its dealing range, meaning this swing point must purge a liquidity pool and offset orders at an opposing liquidity pool. Once this condition is satisfied, this swing point is high resistance. Now, this swing point does what? Purge liquidity and offset orders and opposing liquidity pool of liquidity. Once price trades back into this swing point, it mitigates it, okay? And the idea of mitigation is reduce risk, okay? Probably we'll talk into details in the next video. Once price trades back into this swing point, it reduces its probability, thus making it low resistance. So of course, we now know what makes a swing point high resistance, and I will know what makes a swing point low resistance. Not just in general, idea of a swing point. We are still talking about a rejection block, okay? Because the same way we view area of liquidity around swing points is the same way we ought to view areas of liquidity at rejection block. And this has really not been a thing of it hasn't just been a thing personally, my technical analysis, because I know about the rejection block, but my anticipatory skills when price approaches this rejection block is, I'll say, was really insignificant. I took little or no significance around this area of liquidity, and that's what I'm about to change. Now, just a little bit of recap, okay? All we are discussing here today is liquidity runs, and I try to explain what liquidity is, which we all are very aware of, and I showed where we could find these pools of liquidity in buy stops and sell stops, and we know they rest above and below external range liquidity pools, for example, and also conversely, we've established that this pool of liquidity and this buy and sell orders also rest on the bodies of the swing point that's at the rejection block. And after that, I introduced the idea of the liquidity run signature. The first one, I described how when price closes an inefficiency up to a swing point, okay, you could turn your phone upside down if you're watching this video with your phone. You could use that for a bullish scenario, okay? Because when price rebalances, trades up to deliver price efficiently, the high that forms becomes high resistance, and when price trades back into it, okay, that supposed high resistance becomes a low resistance. So there, and also I say when price there's a transaction that occurs in a swing point, so through opposing through two opposing liquidity pools, that swing point is high resistance. Also, when price trades back into that swing point, it becomes low resistance. So what this chart is here to show is, I want to say it on the chart. I'm very sure everyone is well aware with this chart, but so and also I was trying to define liquidity run signatures, how we can how we can easily identify high resistance and low resistance liquidity runs in price. And I used the classic market structure for higher highs or lower lows for high resistance, and lower highs and higher lows for low resistance liquidity run. Now let's take, for example, this low. I tagged it what? Low resistance liquidity run. We can see price trading back into here. This is the higher low. So this is low resistance liquidity run. Maybe you should take your time to investigate why this is a low resistance. But before then, let's just jump into this. First off, I said when price trades into a liquidity pool, when price trades below this low, okay, and we can assume that, okay, smart money bought to the sell stop resting below these lows, okay, these relative equal lows, okay, and price trade higher and traded into the bodies of the swing point. That's the rejection block, okay. It means there are transactions, okay, two transactions occurred at these two opposing liquidity pools, liquidity pool of sell stops and liquidity pool of buy stops, making this swing point a high resistance liquidity run. What supply and demand, or what people with maybe lesser understanding of the concept of high resistance or high probability swing point, they believe that until market breaks structure, because everyone is only focused about market running pools of liquidity above and below highs and lows. Nobody's really concerned about the idea of pools of liquidity resting above a swing point, the bodies of the candles, and below the bodies of the candles in the swing on the swing point. So smart money buys to the sell stop resting below these relative equal lows, and price traded into the bodies of rejection, therefore purging the stops resting, or will I say sweeping the stops resting at the bodies of this candle. And price traded lower, okay, price traded lower and traded higher as well. Now, why price trade higher, okay, price trade into the bodies of this swing point, okay. This is also the rejection block, and eventually trade lower. Now at this time period, okay, in the market, it's very easy to say, oh, this is a bearish market structure, okay, this is a bearish market structure, and say, oh, this is a lower high, lower low, this is a lower high, okay, this could be very well anticipated, and it's very easy to anticipate a lower low and a run below these relative equal lows. But now that you understand, I have the understanding that once there's a transaction between two opposing liquidity pools, this low in itself would become high resistance, meaning price would fail to trade below this low. So what happened? Price trade lower into the what? The bodies of what? The candle. That's a rejection block, sweeping what? Sell stops resting below this low. Now, this low is high resistance because it rated the sell stop resting below this low, and also what? Traded into an opposing liquidity pool. This swing point in itself, or say this swing point, okay, let's talk about this swing point, traded into the bodies of this rejection block, okay, swept through the buy stops and also what traded into the bodies of this rejection block running the sell stops, making this high in itself high resistance, meaning we've got a high resistance liquidity run here and we have a high resistance liquidity run. Now, I said another thing. When price trades into that supposed high resistance, what happens? It makes it what? Essentially what? Low resistance. Now we are looking at price with the lens of liquidity runs. I'm only trying to just discuss liquidity runs. Now, liquidity runs is not the be all and all, okay? There are other factors to consider, but merely looking at liquidity runs, okay? We are trying to understand whatever happened in that or whatever occurred in price action. Now, this high in itself, we already established why it's high resistance. A transaction at this liquidity pool and another transaction at an opposing liquidity pool. Whatever occurred here, this price trading below this mitigates this level, making it a low resistance. And we see it as what? A higher low. And now you can see here a lower low between this low and this low, making this low what? Low high resistance initially until price trade back into it to make it low resistance. Now, one of the key takeaways to this is that to be able to visually see this, okay, we've got to, pay attention to the details in price. Okay, you've got to pay good attention. And there's actually lots of charts to look at for study purposes, okay? And let's look at what happened next here. Price ran through into this liquidity pool. There were lots of liquidity voids, this void, and we have the understanding of when a swing point, when price trades above, this short-term high, every high subsequently be what? Low resistance until price trades into what? The swing low, okay, this swing point before all of this breakdown. As you can see, the classic relative equal highs and price hasn't traded up here. So this is obviously a short-term high to be run, and price just traded into this level, making this high what? High resistance, okay? Price trade into it, making this high resistance. Now, this low in itself traded into a liquidity pool of sell stops, but didn't trade into an opposing liquidity pool of buy stops. So this low, it's not going to be high resistance, okay? It's not going to be high resistance. And I'm pretty sure even every one of us got confused at this time of the year, last year, when we were looking at this pair, because a lower high is formed, not a lower low, and of course, it's still not forming a high, and it will be very difficult to really understand what's going on. Obviously, we were consolidating, and most of this kind of thing, especially in liquidity run, happens during consolidations. That's why earlier on when I started the video, I quickly sipped a little bit about the application of this in trending condition, okay? But also, we're still going to still push further in trending condition using the idea of liquidity runs, okay? So price trade into here, making this high resistance. Now this high is high resistance, but this low in itself is not a high probability low for a high resistance liquidity run, because of course there was a transaction here for sell stops, but there was none here. Say we ran above any short-term high here, then yes, we could say, oh, this low is high resistance, but the only transaction that occurred was smart money buying towards sell stops. There was no offsetting of the orders initially accumulated here. So this high is high resistance, this is high resistance, but as soon as price trade up to this high, it mitigates this level. This level becomes a low resistance, and that's what you see here, lower highs. Okay, you can see the application of this. I just gave a skeletal structure of how we can visualize high resistance liquidity run, low resistance liquidity run, but this is much more practical. Okay, we are trying to pay attention to details. We gave two variants of the liquidity run signature. We talked about when price delivers through an imbalance, and we also gave the ideas of when price transact through opposing liquidity pools, okay? And that's what we are trying to apply here. So if this was initially a high resistance liquidity run, because transactions below this low and the bodies of this candle, obviously we do not want to see price trade below this low, and there was also a transaction at the consequent encroachment of this swing point and also below the bodies of this candle, making this high resistance. So still yet, we still do not want to see price trade above this high. Okay, then what happens next? Price trade below this low, running the stops resting below this low. Why the price run this low? This swing point is a what? It's not high resistance, okay? It's not. It would have been if we ran above these highs, but it's not. So price trade below this low, running the stops back into the what? The 50% of what? The rejection block. Just like when we say the order block is sensitive at the high and the body, it's just the same thing here, okay? There's sensitivity at the bodies and also sensitivity at the consequent encroachment. You blend in the right narrative, you'd understand this even more. Now, price trading below this low, there's a run on stops below this low. That means there's also a transaction below this low and even at the midpoint of the rejection block. So there is a transaction here and price trade higher to raid the buy stop resting at the rejection block. Now, price raiding the buy stop resting at the rejection block makes this low in itself high resistance. There's a transaction below this low and onto the midpoint of the rejection block, and also a transaction at the 50% of the rejection block here. Okay, so we have a transaction at this liquidity pool and also at an opposing liquidity pool. Now, mind you, this high in itself traded into delivered price into this imbalance, making it high resistance. So when price was gravitating away from this level and gravitating towards this level, we do not want to see price trade above this high because it's high resistance. So what happens? Price trade into this high, and I say when price trades back into a previous level that we consider high resistance, it mitigates it, making it what? Low resistance. And as price trade into this level, you can see it lower highs, low resistance liquidity run signature, lower highs. And when price traded below this low, we can see lower low, high resistance liquidity run signature due to what? The transactions here. And then price trading above here to this high, mitigate this level, makes it what? Low resistance. Okay, it means if you were looking at this maybe on the lower time frame or higher time frame, it means you now have a bias here to say be bearish. If you be bearish, where would you be looking to as primary objective? Definitely this swing point, because this is what? High resistance. Transaction below this low and at the bodies of this candle, making it what? High resistance. And price trade into it. Now, this high in itself is high resistance because price trade into a liquidity pool. Sorry, it's not high resistance. I'm sorry. It's not high resistance, but it only traded into a liquidity pool and what? Didn't trade even up to, assuming price trade into the rejection block here, it will fulfill the criteria for a high resistance liquidity run. Now, anybody that doesn't really understand the idea of the liquidity run, especially from the perspective of when there's a transaction between two opposing liquidity pools, that makes that swing point high resistance. It's more than just market breaking structure, okay? It's more than saying, oh, price runs a liquidity pool. Oh, I'm sure this is high resistance. There must be what? Transactions going on, okay, between two opposing liquidity pools. And since this high is not high resistance and this is a high resistance liquidity run, okay, since price trade into here, just finally mitigating this level, if we want to attack opposing level of opposing pools for liquidity, this high is low resistance because there was no transaction below this low. Okay, it's a low probability. This high has been mitigated by this high. Okay, and also this high has mitigated this high for low resistance and subsequently. So the bulk of these highs in this consolidation have been mitigated, so they're all low resistance now, and you can see price trading freely through these levels. Now, not every high that mitigate a previous high is automatically low resistance. Now, this is what I'm trying to say. Even for the fact that this high trades up to this swing point, mitigating this high for making it low resistance, this in itself is not low resistance, because if we consider the template for what makes a swing point high probability, okay, it traded into an imbalance, making it high resistance, and price swept below an old low. Okay, there's transaction between in this swing point, so this is definitely high resistance. Even though there is a low resistance liquidity run signature, you might not want to be expecting price to trade above this level yet. But once price now trade into this level, now mitigating this level now becomes a low resistance. And price failed to trade into a supposed liquidity pool, it only traded into an order block, okay? Therefore, picking more orders, giving smart money what opportunity to go increase their position, go long at even a very deep discount after a sweep on sell stops, allowing them to go long for a raid on all the buy stop pressing above these highs. Okay. I haven't talked about that. This is obviously this is a consolidating market, and in this market condition, this is what we generally say, oh, prices move in between two extremes. Okay. We have one extreme here and we have another extreme here. So prices is moving in between two extremes. So how then can we use the idea of liquidity runs to maybe define setups here, or basically define setups? Because the only reason why we're all learning foreign exchange and all of that is to make money, of course. So if you can't make money with what you know, then why do you know in the first place? Now, first off, I would like to really show us the high resistance liquidity run. All of those highs that have the red triangles, they're high resistance, and of course, we know why. Okay, this swing point ran below this low. Okay, and price trade higher, trade into the bodies of these candles. This is an opposing liquidity pool. Okay, trade below, ran below the sell stops, trade into the buy stops here. So this is a high resistance liquidity run. This high in itself traded above this high and also traded below this low, making it also high resistance. This high in itself, it traded into previous highs that I couldn't just capture it. So it is high resistance in itself. And this high in itself traded above this relative equal highs as we know it, and also traded below the bodies of this candle, the rejection block. This high in itself traded above this high, and traded below this low. Okay, high resistance. This high traded into the bodies of the candles, and of course trade below these lows. So this is high resistance. And the idea of spotting this high resistance liquidity run is that you have a setup, because whenever price trades back into it, you have a very high likelihood that it's not going to run. Now this chart, if you ask me, this is for like the 75 index. Okay, you can check it if you want to. Okay, so and the theme about this is once you can identify a high resistance liquidity run, definitely you have a setup there. Okay, when price is consolidating, you identify a high resistance liquidity run, just buy at premium or sell at discount. That should be your trading template. Also here, I'm showing you highs that mitigated previous highs that were high resistance. Initially, I showed you high resistance. You can see it trade above this high, higher high. Okay, high resistance liquidity run, higher high. And I told you already what makes a high resistance transaction between two opposing liquidity pools. Okay, it's not just it runs a liquidity pool. That's not enough. There should be transaction through two opposing liquidity pools. You could use the narrative of rejection block or old highs. Okay, many people really do not get it because why? The idea of the rejection block is always away from the idea of this this concept of liquidity. So price trading back into this high makes this high what? Low resistance. It used to be high resistance, of course, but price made it what? Price trading back into this level makes it low resistance. But it still doesn't mean that this high, though it's low resistance, white represent low resistance. Okay, you can see low resistance liquidity run signature lower highs. This in itself is still high resistance with respect to this short-term high it ran and the transaction below this low. Now, when price trade into the bodies of this candle and traded back into this level, this low made it what? Low resistance. So as soon as price traded up here, running this short-term high, mitigating this previous high, you already have a setup to go short to run what? These lows, making these lows what? Low resistance. So you can see how price is aggressively what? Trading through these levels. I think the idea for this whole liquidity run is so that we can frame setups. It could be in consolidation, it could be in trending markets, and I think the last slides of this will be for heavy trending conditions. Okay, because I get a lot of people at TW say, whenever prices is trending, I just stay away from it because I can't find entries. Lol. So, and when price trade above these relative equal highs, this high is in itself is high resistance, but this high in itself, although mitigates this high, but it's high resistance if it fills the criteria. So even if you are buying at this level, okay, you are buying somewhere in this level, you don't expect price to trade above this high. That's why I said not every high that mitigates previous high is low resistance. Okay, you'd have to understand the flows, the transaction between two opposing liquidity pools to qualify if a high is low resistance or not. So price trading running relative equal highs mitigates this high, but this high in itself is high resistance. Why? Once you mitigate this high, trade into the bodies, making this high resistance, although mitigating this high. So now we have this high mitigated by this high, and this high mitigated by this high. So we have low resistance here, but high resistance here. So we don't expect price to still trade above here. So price trade here below the bodies of this candle and traded higher. Okay, price trading higher mitigates this high. Okay, this high becomes what? This high becomes low resistance liquidity run, and price haven't traded back into this level. Okay, price trade into this order block as you've seen, and now this high has been mitigated. Now this high is of course low resistance. There is no transaction between two opposing liquidity pools, so price already mitigated this high, and then you can see how price just rushed through. Okay, these are low resistance liquidity run signature lower highs, and the only reason for price to trade above these highs is because these highs have all been mitigated. They are all low resistance. Now as price successfully trade above this high and trade below this low, of course this high becomes a high resistance, then this low in itself mitigates this low. That means every swing point below this low are all low resistance. This mitigates this and this mitigates this, and now price trade into this. Okay, this high is high resistance, so it would only make sense if you are anticipating price to trade below, for price to trade lower once it gets up to this swing point, because this swing point already meets the criteria for a high resistance liquidity run. You can see transactions above this pool of buy stops and below this pool of sell stop, even up to this rejection block here. So price trade lower, and of course ultimately you'd want to wait for a run on liquidity or anticipate a run on liquidity below these lows, all of these lows, because all these lows offer little or no resistance because they've all been mitigated. Now, just a little more study of liquidity runs. Okay, we can see price trading below these relative equal lows, and when price trade below these lows and trade above these highs, we can see the transaction between two opposing liquidity pool of buy stops and sell stops. So definitely this low in itself is high resistance. Now take a look at this high in itself. This high in itself trade above an old high, and also it trade into a pool of opposing liquidity pool. I need to be sure this is okay. I just wanted to make sure I was not talking. Let me see how long I was talking. Wow. And trade into a pool of opposing liquidity pool of sell stops. So this is high resistance, this is high resistance. But before it became high resistance, it traded into this. Okay, assuming price just traded into this order block, then definitely it will be the classic breaking market structure and the return to order block and higher prices. But that didn't happen because we traded into a pool of opposing liquidity that sell stops, so making this high resistance. So if you were a buyer, say somewhere here or here, you shouldn't be expecting price to trade above this high because this high in itself is high resistance. Now, since price trade into this low, this makes it low resistance. You can see low resistance liquidity run signature, high resistance liquidity run signature, high resistance liquidity run signature, low resistance liquidity run signature. And you can see when price ran into high resistance, these lows will offer little or no resistance. So you can see. And this is one chart I need to share because this gave me this is the euro dollar actually, I think 10th of December. Okay, and I was selling short actually from this level because we ran relative equal highs here, trade into a PD array, and I was selling short here, and I was looking to cover my positions here, and everything reversed on me, and I had sleepless nights trying to understand what really happened here, and eventually I got the answer to my question, and I finally realized that when price trade into the bodies, okay, there's definitely a transaction here, and trade above this low itself, this low is high resistance. Now price ran relative equal highs, trade into some other block. This high in itself is high resistance. We trade lower, but what did they do? They mitigated this high first. I wasn't seeing this level as high resistance then. Why? Because I failed to interpret high resistance liquidity run in terms of transaction between two opposing liquidity pools. And I saw this as relative equal low. And also, I failed to see it in terms of the rejection block. So I just classified everything as well, relative equal lows. And I took the trade. When price trade into this level here, it created some bearish order block. I sold short into it. I think I have some guys watching who saw me even take the trade and stuff like that. And everything just reversed on me. And I beat myself up. And I said I was going to find the reason why this happened. And a friend of mine, David, we've been having lots of experience with the markets lately. That's all I would say. So obviously, this high becomes mitigated, and a run into this other block that took stops at the rejection block is high resistance, now becomes mitigated. So obviously, price ran through easily. Now, after everything, you can see price just came back to trade below all of this low because these lows have been mitigated finally. Now, I'm trying to just be in a hurry because this is the last focal point for this lesson. I've already discussed trending conditions and even and consolidating condition, but there's still something I need to address. Now, when we look at these two scenarios, this is actually the same chart. This is euro yen, okay? This is a rally. This is also a rally. But now, who can tell me the difference between these two? Okay, I'm waiting. All right. Um, I think this is more strongly bullish than this. Price is obviously trading efficiently here, and in contrast to lots of inefficiencies here. So I think here most people can easily find setup here because there's a lot of return to order blocks, and if it's consolidating, you could just apply, the bulk of things I already taught in consolidating profiles. Okay, it works on an old time frame, any time frame. So this trend is obviously weak, very weak. That's why we can see lots of efficient price delivery. But this is a very strong bullish trend. So how do we use the idea of liquidity runs to maybe look for setups in this kind of condition? Okay, because it's very important. Our goal in 2022 is to trade every single market condition, whether it's consolidating or it's trading in large ranges. Okay, but we might not be able to get setups every single day because day trading is not everyday trading. Not because you can't do it, but because the high probability setups you can find for day trading won't show up every single day. That's just the reason why. That's the reason why day trading isn't everyday trading. Okay. So I just pulled up the chart. Okay. The one we saw trading in large ranges. This is the 4-hour time frame. And of course, in price action model 4, I was teaching trading the weekly range, and I was discussing how the algo will seek near-term internal range liquidity. And I said one of the key components of that model is that we must be prices must be expanding quickly. That means we should be in trending weeks, not consolidating, okay? Because it won't work. And when that happens, the only way you can actually find setup, this is the 4-hour time frame, is via the mechanism of institutional order flow entry drill. When the markets are predisposed to go in a particular direction, the only way you can get your entries, it could be maybe prices have expanded so much, and maybe if we're still in the same in the same 24-hour time period, you could maybe just get entry drill maybe during New York session. Okay, but typically if you want to be trading the higher time frame for more probability, like I will be trading and this year, you can see how price trade into this imbalance. Okay, and in my experience, whenever I see the order flow entry drill, the probability that an opposing liquidity pool gets raided is astonishingly very, very high. Now you could count the amount of setups you can even find on the 4-hour time frame here. This is about the 7th of October, the 8th of October to about the 19th, and you can only get 1, 2, 3. Say this return to order block 4, 5, 6, just 6 setups in the span of like 10 days. Okay, but they are absolutely high probability. Now, everyone say, oh, so Albert, if prices trade into an imbalance, do I just buy it? No. I'm actually going to give a very good example that we're going to work with immediately after this slide. This one is long, October time period ish. I don't know. It was very difficult trying to just pull up this chart on lower time frame because we are going to study the liquidity runs here, especially during the entry drill, because whenever we see an imbalance like this, definitely we know there's a low here. So it means when price trades below this low for institutional order flow entry drill, we are purging already sell stops. And if an opposing liquidity pool probably was traded into, that means this low in itself becomes what? High resistance. High resistance liquidity run, lower low. And then when price trading back to that level, it could be in the lower time frame. You don't always get to see everything on the higher time frame. Okay, that means you have it set up there. Same thing while price trades into an opposing liquidity pool. When price is trading back into that dealing range, you could check lower time frame. You probably have it set up there. Now, let's look at the British pound, Japanese yen. We already went over it previously. How we really discussed about, we really use this chart to really teach about the high resistance and low resistance liquidity pool. okay, and already I will just be showing just the same things here. Then I don't think there is just so much to talk about, but this is exactly what I want to talk about. Okay, this rally up here. So how do we trade these rallies here? I already mentioned institutional order flow entry drill, because it will be really difficult. Look at each daily low, just a little bit retracement, expansion. There was almost little or no return. So if you do not have your setup here or here somewhere in these days, definitely when price was trading through this high, you would definitely not get set up because it just happened overnight. Now, we already explained everything. We really talked about the whole idea of high resistance liquidity and how this became to be bullish for the British pound, Japanese yen. Okay, and while it was bullish, you can see here order flow entry drill, price traded into, running the sell stop resting below this low. Okay, trade above this short term high. Okay, you can see exchange between two liquidity pools and price traded back into this order block. This order block is high probability. Why? Run short term low, you can see price trading above the short term high. Expansion. Little or no setups in this time frame, except you maybe probably go through lower time frame. But this is the 4 hour I'm talking about. If you go through 2 hours, there are other miniature entry drills that occur. Okay, you can see institutional order flow entry drill. So when the markets are predisposed to go in one direction, okay, these are the sort of things that you'd want to be anticipating and expecting in price, especially in large ranges. When price is trading efficiently, okay, you can use your normal return to order block, like areas such as this. But once we're in large ranges, this is only how you can get in price, because imbalance will be filled. The algo is just reaching for opposing liquidity pools. And I had plans to really talk about everything that happened here in this portion of the slide, but I already talked a lot about it, how this was high resistance, it mitigates, this high becomes high resistance, mitigates, and all of that. But the thing is, blending the seasonal tendency, for the month of October, the yen was very bullish. Now imagine if you studied price, or you had information of this, and price was coming here and we just got into October. Is this not a swing trade? Now, there's no need to bite your teeth and I think or anything else, because all of these things will repeat. Okay, this year, the year after, that's why when market begins to consolidate like this, liquidity runs is the only thing, the only explanation to our prices book. Because even if institutional order flow is bearish, when prices starts to consolidate, okay, the ideas of market structure becomes flawed. It becomes totally flawed, because what's actually lower highs and lower lows, and then market is suddenly going up? How do you explain that? So with a strong bearish seasonal tendency on the yen to be bearish, you can see high resistance liquidity run, return to order block. It becomes very easy. Sorry, we have to talk about this in hindsight. Okay, that's the only way. Okay, you have to study these things in hindsight. Now let's look at the yen. Okay, this is recent price action in British pounds, Japanese yen, and I recall somebody sent me chat and looking for like price to turn when it approached this level, and I said these highs will be raided. And if you are watching Adam, everything I've been saying so far explain why I said this high will be taken. Okay, this is low resistance liquidity run signature, price trade into an imbalance and price trade back into it, making it what? Low resistance. Okay, and when price is coming back into it, I expect little or no resistance of it from this level. And I want you to see how price is trading away aggressively. There's a setup here, there's a setup here, there's a setup here, there's a setup here. And you can see this entry drill yesterday. This one happened yesterday, specifically in, you know, in London session. And personally, yesterday I had my limits set here for a New York OT, but today I decided not to trade. Today being Friday, I decided not to trade, and eventually got triggered, but not on the trade. My limits were off. Okay, so you can see entry drill into the imbalance, entry drill into the imbalance, entry drill into the imbalance. So how do you trade after all of, mind you, this is 4 hour time frame, so you have set up 1, 2, 3, 4, 5. Wow. Now once price trades into this, whatever is happening here, okay, I'm trying to zoom in here. Okay, I'm only going to use this portion of price line to explain how entry drill works, how you can use it using the higher time frame, liquidity pools. So when price runs below, or when price runs below this low, okay, if you say smart money bought to sell stops, okay, this low hasn't been mitigated here, then price trade above this short-term high, making this low what? High resistance liquidity run. Okay, there's transaction between two opposing liquidity pools. Now this high in itself, although ran short-term high, while price trade back into it, it made it what? Low resistance. Okay, so when price came back in New York open, okay, this will now be your classic what? Optimal trade entry for longs, of course. So where will be your target? The liquidity resting above these highs. But what do you think would have happened if we ran the rejection block here? You can see, and price also traded into the rejection block here. Even if you trade into the rejection block and we're trading higher, it will find it difficult to trade above this high, because this high in itself would be what? High resistance. So this is what? Low resistance, and price right into it for a run on liquidity. So essentially, I talked about liquidity runs. I gave various instances in consolidating market. I gave what makes a swing point high resistance. I already told what makes it low resistance. Of course, right now, this is a low resistance liquidity run, okay? Because it mitigates this level. Initially, it was high resistance, you can see lower low, okay? So I gave different instances how we can relate to this liquidity run signature. We use it for entries and whatsoever, and if you use it to blend it on the higher time frame, obviously that's what we'll be talking about in the next video, how it applies on the higher time frame. So I hope with this video it gives answers to lots of your questions. For me, it's another breakthrough in my trading career, and I hope it does work for you too. But I would really advise that you really take your time to watch this video. You could watch it over again, it doesn't matter. I know it's a long video, and personally I'm so exhausted. So I wish you good luck. So in the meantime, happy new year.